Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be doing a stock analysis on Snap-on Inc. And for those who don't know, basically Snap-on is one of the world's leading manufacturers and distributors in professional tools and equipment, primarily for mechanics, technicians, kind of more of the professionals like that. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks, want to get good ideas of potential stocks to buy, or want value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, you can feel free to leave it in the comments below, as a lot of my videos are based on subscriber requests. So let's get into the stock analysis here. So looking into the stock analysis, we're going to look at some of the top level financial metrics. And you can see right now, basically Snap-on Incorporated, they have a market cap of $19.6 billion, which will be a little bit potentially relevant later. The PE right now is sitting at 19.54, with only a slightly lower forward PE of 19.14. So while this is more of a little bit modest PE compared to a lot of the tech companies nowadays, the forward PE is suggesting there's basically minimal growth going forward at least 1 year in the future. If we do check out the Guru Focus Value Band here, which sometimes can be accurate, it is saying they are potentially modestly overvalued. So we're going to be basically seeing if that is accurate. And for those dividend investors, they do pay a reasonable dividend yield of 2.51%, and they do have a little bit of a share buybacks as well. So diving into the 30-year financials, on the right here, you can basically see the revenue trend line. And trends like this are important because they basically help us project the future growth of the company. And you can see the blue line here is basically averaging about 4.52% per year, and the green line is the realized basically trend with behind this kind of blue background here. This is based on the analyst projections. So right now they more or less are kind of expected to go at this 4.52% per year, but there actually is expected to be a little bit of a dip in revenue basically in the current year, which will lead them to be slightly under that trend. So this is one of the things you need to understand about basically Snap-on, is that they are a much more mature company, and they have very limited basically growth opportunities, since right now it looks like they may actually be a little bit under this 4.52% growth. But if we take that onto a per share basis, we can see the revenue growth has actually been at 5.3%, and this is mainly fueled by share buybacks, where the EPS has greatly exceeded that, which I'll explain as we get further into the analysis, and that's sitting at 9.6%. So getting in, one of the first things we can kind of glance at to kind of see where the company's at is we look at the return on invested capital and weigh it against our weighted average cost of capital. You can see right now the return on invested capital has actually been improving over the years, which is a really good sign. It's up to almost 17.5% there. So that's a very good trend for basically Snap-on, that well, they are a slow growing company. When they basically actually do invest, capital assets into their company, they are getting good returns on that. So that is a good positive to see. And we can see basically driving into their income statement, they have had relatively basically slow growth, as we already know. And that's kind of also what's expected to be going forward in the future. But on the good side here, the very positive side, is they do maintain very strong gross margins. And if we actually look at the last 15 years, they've actually been able to manage to creep up their gross margins a little bit. It's got up to about 51.6%. In the past, 51.97, we're splitting, hairs over, a quarter of a percent basically at this point here. But this has increased from previous years, going back to 2011 when it was 47.37%. But looking basically at this trend here, they've been maintaining around this 51% range basically for the last 10 years. So this is probably what they're going to be basically maintaining in the future, or at least what we want to basically see them maintaining. Because one thing is, if companies do start losing their competitive moat, you're going to see them either lose it on the gross margin or the operating margin. So this is one thing we're going to want to watch on Snap-on, is that they're able to maintain above this 51% gross margin range, basically, because if that were to drop, that would indicate some weakness in the company. But on the very positive side, is what is increasing a lot is basically the operating margin. And if we go back to 2011, their operating margin was basically 15%, and this has actually increased up to over 25%, with that kind of peaking out actually also in about 2023. But there actually could be a little bit basically more margin expansion going forward, which is a good sign. That is actually unusual for a lot of companies, is that as they're able to basically scale their top line revenue, their other operating expenses, such as their selling and general admin, are increasing actually at a slower pace. So this is something that may already be basically stabilized right now. It has been around this 25 percent range now for a few years. But this is something we could potentially see creep up in the future based on the previous trends. But this is one thing you basically kind of want to gauge is the gross margins and the operating margins. That is, the company does have a strong competitive moat, and from what I'm seeing, increasing operating margins here and maintaining the high gross margins does indicate they do have a very strong competitive moat, basically despite the very low revenue growth trend there. And when we get basically into their interest here, you can see they do have a little bit of positive interest income. They do have a little bit of interest expense, but it's very, very minimal. So we already know that basically they have a very healthy balance sheet because basically their net interest income here is just at $8 million, which basically shows that kind of on a debt basis, they do have a little bit of debt, obviously, that they're paying interest. They do have assets they're earning as well. And they probably could pay down that debt if they wanted, but it's probably so cheap that they don't want to, actually having debt is not always a bad thing because then you can use the money to do other things, which, they're actually earning some interest on. And basically that kind of comes down to the bottom line here. And that's giving them just over $1 billion of basically net income and a net margin of close to 20%. And you can see how much this has basically grown over the years. And that's what has driven that higher than average basically EPS growth, which if we scroll back up here, the EPS without non-recurring income, over the last 10 years, I was able to average basically 9.6% because, let's just go back down to the income statement here, because basically their net margin has grown. And that was a combination basically of originally the gross margin getting up a little bit, the operating margin basically almost increasing year over year, and also because of basically the tax cuts that happened, the tax rate was able to go down, which helped continue increase their net margins. But even though this basically net margin growth in the past has been really good and does give you the illusion that, hey, they're going to be able to grow their net income basically at this, at this higher rate of the last 10 years, which was 9.6% going forward in the future, that's probably unlikely to happen at that rate because right now, there's most likely not going to be any more basic tax cuts going in the future. And basically looking at where their gross margins were, there's not much room on the gross margins and the operating margins. It's very questionable if they're able to basically improve those a little bit more as well. So we're going to kind of be looking at basically their EPS growing more in line with their revenue and then accounting in for basically the share buybacks. Because when you do get onto the shares outstanding here, you can see they basically steadily have been increasing them every year. Why not by huge amounts? It is a little bit by little bit, which is one of the ways that basically are returning that capital to shareholders. When we get on to basically the balance sheet, you can see right now current assets sitting about $4.5 billion, and where they're making that interest income is basically from this cash and cash equivalents they have sitting here. So right now they're earning a little bit of interest off that, but they could always basically use that for buybacks as well. But a lot of times, sometimes companies do like to wait to more strategic basically times to basically buy back their shares when the shares are cheap. So, if Snap-on shares really aren't that cheap right now, it's probably good right now. They're sitting on a little bit of extra cash. When we look at their basically total current liabilities, the total current liabilities is very low, under $1.3 billion compared to the 4.5. So this is a very, very strong current ratio. And they effectively have over $3 billion in additional assets, kind of between the cash, the total receivables, and their basically like their inventories there. So it kind of is a very good financial position to be in. And they do have basically total assets at the end of the day of about $8.5 billion. And we do kind of have to subtract out the goodwill, which is $1.1 billion, which kind of happens from basically acquisitions along the way when you pay over the book value of the acquisition. And in comparison, total liabilities are basically sitting at $2.5 billion, and that's giving total stockholder equity of almost $6 billion. So even if we subtract out that $1.1 billion of goodwill, we're still sitting almost at $5 billion, more like about 4.8. That's still a very strong total equity position to be in, because as I said before, the market cap at the very beginning of the video was $19.6 billion, and we're sitting at almost $5 billion of basic kind of tangible total equity on the balance sheet, a lot of it cash and receivables. So it is something you kind of have to factor into the valuation. So I would basically say Snap-on basically here, they have, a very strong balance sheet, and a large amount of their assets kind of is accounted for in the, their total market capitalization. So when we do see kind of that 19, 20p ratio, you do have to realize kind of if you were to pull all that money, extra kind of capital out of the company and just look at what is basically the business itself is actually trading at a little bit lower P ratio than that 19, because they could use this $3 billion to buy back shares and buy back $3-4 billion to buy back a sizable amount of the company basically at the current time. And, going back basically into their liabilities here, I'm just going to point out that there is this little bit of basically long-term debt, and they have actually decreased it a little bit in basically the recent years. So that's kind of interesting. It was sitting at about 1.18 billion, and they've actually decreased it a couple hundred million down to only 887 million. So they basically did have some long-term debt they did pay down. I didn't look into this specifically, but it might have been that they had some bonds maturing, and they just basically decided to pay it off with their extra cash. 200 million is like no really big deal for them, rather than basically rolling them over and issuing new debt. And then we can see when we get on the cash flow statement, one of the first things I like to look at, you look at basically the cash flow from depreciation and compare it to the purchase of plant, property, and equipment. And sometimes you can find some interesting stuff which is going on here. And, with Snap-on, basically, since they are a very mature company, this is much more what you would expect. And actually, the purchase of plant, property, and equipment is actually a little bit under basically their cash flow from depreciation. So that also kind of indicates, although it's a very, very small amount, and in a lot of these years, like 2023, it's basically in line, that the net income we're seeing, potentially is actually a little bit higher on a free cash flow front, since the net income is basically, based off taking off this depreciation, when in reality, the amount they're having to, repurchase every year is a slightly lower amount. And this is more what you should expect for a healthy company, a healthy, mature company, is what I'm kind of trying to say there. A slow grower being, mature company there. And they do some small acquisitions along the way. You kind of see 38 million, 160 million, 200 million. So they do buy small little acquisitions along the way, and that is probably something they basically will continue going on in the future. And from the goodwill we're seeing on their balance sheet, this probably, and the fact that the goodwill actually hasn't, gone down in the past. Let's just bring up where the goodwill is here. It's always basically increasing. This probably is indicating, well, you can actually see it increase there, that there's very minimal write-downs happening with the acquisitions they're doing. So that is one way they are basically helping fuel this little bit of growth. And if we were to probably take this purchase of business here and kind of just like average it out basically over all these years of purchase of plant, property, and equipment, the purchase of plant, property, and equipment basically probably is a little bit more in line with their cash flow from depreciation. So, retracting what I said previously, they probably kind of are what we're seeing on the income statement, is, fairly accurate on an average kind of free cash flow front. And there is a little bit of stock-based compensation, very, very minimal. Not being a tech company, it's, not very much. It's actually decreased over the years of only, $31 million in the last 12 months here. And then how are they basically returning this capital to shareholders? Well, you can see basically they do some share buybacks, and it's being a little bit fluctuating year to year, but they're kind of using this 200 to 400 million range, with 341 million basically in the last year. And they also have, cash flow from dividends of $477 million there. So that leads to just a little bit over $800 million, which actually is less than basically the free cash flow. And you can see in the last few years, the free cash flow, for example, has been over $1 billion, which is basically kind of like in line with the net income from operations there. And if we compare that to the amount they've basically done with their cash flow from dividends and the repurchase of stock, it's considerably less. So this is one of the reasons why they basically have kind of been building up this cash pile on their balance sheet here, because although money they're getting in, they're actually kind of keeping some of those profits within the company, which may be a good idea, because one of the big things that I bring up a lot that companies like end up doing, which can be to the good or kind of bad things depending if when you actually want to buy the stock, is that they end up buying back a lot of stock when basically the price is high, and then when their price crashes down, they don't have any money put to the side and they can't repurchase any shares, and then when the stock's low, they actually stop repurchasing shares. So Snap-on is basically a company that is very unlikely to be in a position like that, and actually is kind of building up a stronger and stronger balance sheet as they're going on. So overall, basically looking at their financials here, the company is very strong, sitting in very good condition. They're just a very slow growing, basically steady company, but they still have their moat. They have a very strong balance sheet, billions of extra dollars, and they're actually kind of have a little bit of war chest basically on the side for times get bad. So really all it comes down to for a stock like this is really, what is the valuation looking like? So we need to come up with what is actually a good valuation for the stock. So, the typical type of analysis I do is, very good for, this type of analysis here. So let's bring up this type of stock, I should say. Let's bring up with the revenue with estimate. Let's bring up with the EPS with estimate. And we can kind of see what the expectations are. Is basically expected, continuous growth in the future, kind of in line with what more they've basically done in the past. And I will just bring up this here. This is my basically earnings discounted cash flow calculator, not a discounted cash flow calculator, but a discounted earnings calculator. So if we kind of take this this EPS estimate of $28 right now, and basically that would kind of imply there's a 8.6% EPS growth per year. And before I get into basically these numbers here in the PE, let's jump back to here. But I'll just say that based on what we kind of like looked at previously, achieving an 8.6% EPS growth may be a little bit optimistic in my opinion, because if the revenue growth has only been, on a per share basis, averaging 5.6% per year, this would have to imply that they're going to raise their margins more, which I think that'll be very unlikely since the gross margin is not going to basically raise significantly. They're not going to be getting I wouldn't think any big basically corporate tax cuts that are going to be able to raise it. And if there is anything raising basically margins elsewhere, it's only on the operating margin, which would be very minimal basically year by year. And I don't think it could kind of close that gap between that 5.6%, which again is already factoring in basically the share buybacks, to reach that 8.6%, which the analysts seem to be expecting now. So that is one thing to keep in mind, is sometimes these analyst estimates are based off all the basically kind of past performance they've done. And when the company has had a big margin basically expansion cycle, like they have with their operating margin, and therefore their net margin's growing a lot, you kind of have to use your own intuition, not intuition, but your own analysis to determine, is this actually a realistic thing or not? So while I do use analyst estimates a lot in these, there is sometimes reasons I do disagree with them. And while the company is very strong, I think it's kind of unlikely that they would be able to meet this 8.6% EPS compound annual growth rate. So with that, let's bring up some of these other metrics here, and we can bring up the PE ratio, which I think for something like Snap-on and their consistency would actually be a pretty good relative value metric. And I just want to get away from this big blip here. You can see they're sitting at 19.54, which historically has been on a little bit of the higher range. They sometimes do peak into the 20s, but it's typically only the low 20s. Even before 2008, well, they did get up to 30. And this is, I guess, one catalyst that if you were really bullish basically on Snap-on, that you'd be kind of hoping at this point, is you kind of say, hey, I think this company really isn't, a 20p company. It should be a 30p company. And, kind of really at that point, you're just betting on multiple expansion, and a multiple expansion that basically hasn't occurred since, basically pre-2008. But, typically here, 20 has been kind of the high PE, and then when they're getting on the lower as well, it's like kind of below 15. You can see it's 13.5 here, 12.5 here, basically during 2020, it went even below 10. So kind of more on the lower side, you're kind of looking at maybe 13, 12, or even lower as the more attractive times to basically buy Snap-on from a PE perspective. And if you actually kind of look and compare to the chart, the blue line here, those all would have kind of been, pretty good times to basically buy the stock. And then even in, 2008, 2009, it did get all the way down to basically a 5. So on this PE basis here and the steadiness of the company, I kind of do not think this is the most, kind of attractive valuation. Although, taking that back just a little bit, we can kind of garner from the little bit of stronger balance sheet they do have, that this actually could justify them creeping up the valuation a little bit. But I wouldn't say it's that much. So let's just bring up the price to book ratio, just out of curiosity here, because that's kind of one other way to look at it. And you can see even on a price to book ratio, it's not relatively cheap. So while they do have this very strong balance sheet, and it has been basically higher in the past, it isn't incredibly cheap, even if we kind of factor in on a historical context, all that extra cash and assets are basically sitting on their balance sheet. If we apply that in, well, it's it's basically factored in here when it would be priced, around the high of a 20p ratio as well. So we probably are sitting on a more realistic higher range for the PE, although it is possible that it would potentially creep a little bit higher, basically, in my opinion. Now, if we bring up the price of sales, because the margins have been expanding, this is not going to be as basically useful as a metric. And kind of as expected, the price to sales ratio basically has expanded because the margins have expanded. And we can basically see that if we bring up the margin here. Let's just bring up the operating margin, because sometimes I find the net margin with the taxes kind of skews things a little bit, but this kind of shows the actual underlying performance of the company. And you can see before, pre-2008, they maintained at this much lower operating margin, and they've kind of really had this expansion basically over the last 10, 15 years. But as I was saying before, it does look like it could be plateauing out. Since 2016, there's been very minimal basically margin growth that's happened, although it could creep up a little bit, but definitely not enough to justify that 8.6 EPS growth based on the analyst estimates there. And one other way we can kind of look at valuation is basically look at the dividend yield. And as I always say, basically in the videos, for a lot of these consistent stocks, when the dividend yield is high, well, that's when the stock is really low, and that was basically the time to buy the stock. And this holds very true for Snap-on here, as every time if you kind of bought the peak dividend yield there, it's when the stock was at a relative low point. That would have been actually a very good basically time to buy the stock. And getting back just into the dividend yield, obviously we can kind of tell from the previous financials that there's not any risk of a dividend cut. If anything, they probably could be raising the dividends more, which kind of is something you probably could expect basically going forward with Snap-on. So right now, sitting at 2.4%, well, it is kind of a safe dividend yield, and they're likely to basically grow it in the future. It's not a very super attractive price. It's kind of more, average, if anything. You definitely can go a lot higher. If it got about 3%, that would kind of be the much more basically attractive place to buy Snap-on. So overall, so far, you can see, in my opinion, I do not think it's basically actually the greatest valuation. So kind of now bringing back into the my EPS kind of calculator here is I have my mid kind of high P at 18 and 20, as these are kind of like the two targets which I think are on the higher P range. And if you were to base off these more aggressive analyst estimates here, you would only be getting basically, not counting the dividends, a 6.6 to 9 basically percent compound annual growth rate. And for a consistent company, that's, might be reasonable if you already hold the stock and you have a lot of unrealized gains, basically, that you don't want to realize and pay taxes on. So it might be a hold from that perspective, but I don't think this is definitely a very attractive price to buy basically a stock at right now. Even if you were expecting that a little bit higher multiple, even getting up to a high P of 25, you really only get up to, a higher compound annual growth rate of still under 15%. And also, if we kind of adjust this EPS CAGR down a little bit by saying, hey, these EPS estimates are a little high, let's bring it down, which I think this is a lot more realistic. You can see how poor potentially the returns get, which I think is a little bit more basically accurate of an EPS than maybe realized, as this is more in line basically with that revenue per share growth trend line that they've been achieving in the past, which would kind of project their current revenue trend basically along with the share buybacks on top. So how does that look like on the chart and the technical analysis? Well, you can see kind of here, I have this longer term trend here. And while this longer term trend has been going at 8%, nothing's basically fixed in stone. And I kind of do have this more sub trend here. And, personally, what I would be looking at for Snap-on is I actually, would want a fairly large correction, and some may even call it a crash. And, kind of the price I would personally be looking at is about $230. This is kind of where this previous consolidation basically has been. And if we, I think, pop this to a monthly here, it gets more into a little bit of the longer term moving averages we could see of like, the red one here. And well, a lot of times you can see actually punctures through there. And that actually does mean that it wouldn't be surprising actually if the stock were to crash, it could easily come down here. And trust me, if the stock starts seeing a little bit of basically like a margin compression, it will definitely re-rate a lot lower quite quickly. So, even 230 down to 171, I think would be a much more interesting place to buy Snap-on. And if we kind of plug that into here, you can kind of see if we take the current price, put 230 in here, and even with my lower basically EPS estimates here, this does start to become a little bit basically more attractive for this kind of like slower, steadier company, which for slow companies, you can't expect as high basically compound annual growth rates when there's more predictability for them, which I think is basically true with Snap-on. And if we were to kind of bring 170 price, then it basically starts getting really attractive. So anyways, that's kind of what I would be looking at from Snap-on, from a fundamental, from kind of a valuation of the returns we can get, and even from a technical perspective, it's kind of more waiting for probably even down to this 170 price level, or if more time passes, well, that gets higher and higher, but kind of between 170 and $200. And if you kind of look at the 200-month moving average, interestingly enough, it's like best time to buy Snap-on there. This time it punctured there, but this would have been a great time as well. These would have been good times as well. So historically looking, that actually would be kind of a reasonable target to kind of wait for, is for the 200 monthly moving average. And as time passes, that is going to basically creep up. So it might be higher in the future by the time the price gets down there. Right now, it's sitting at about $170 per share. But that's kind of what I'll be targeting for Snap on. If you kind of do look at the price action in the past, they kind of do get these, very long sideways periods, and sometimes, that might mean it moves sideways until the moving average catches up, which may mean, I wouldn't be buying Snap on for potentially, 5 years, or that's, when I'll be looking until the price basically catches up to the moving average there. I'm saying, something like this, and then, the moving average basically catches up there. That's one way for basically things to happen, or, it can basically just come straight down. But, well, Snap-on basically is a very, stable stock and is doing very well. I definitely see that it could be re-rated down if there is any weakness, basically, in the multiple itself. And you kind of have to compare this point right now is, would you really want to hold the stock even though potentially it has, good fundamentals, and, you're going to get potentially that steady return of, maybe like 8% or something? Would you really want to buy it here and then have it go sideways for all this time? Or, buy it here and you're, potentially sideways for a very, very long time in price. So anyways, that's my analysis on Snap-on. Well, I do think it's basically a very, solid company, very good financials. That's kind of all being priced into the stock right now, and therefore I do not think the stock basically is very good value to buy right now, and I'll be wanting to wait basically for lower prices. But like a lot of stocks, basically is on my watch list. I have a very large watch list, and I try to, kind of wait for the stocks that present the best, potential reward opportunity on the upside. So with that, I hope you enjoyed the video. Leave any comments basically below. Make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis.